makes you so sick at heart that you can't take part. You can't even passively take part.
It should come as a surprise to no one that I'm not a huge fan of Larry Summers. If you don't know who Larry Summers is, he was the Treasury Secretary under Bill Clinton during the 90s. He was also the director of the National Economics Council under Obama during the early years, especially in the immediate aftermath of the global financial crisis. He is someone who has always been very close to power when Democrats have been in office. And this is rather troubling because his economic ideology is, broadly speaking, conservative. He is best known for his pro free market views, his pro deregulation views, especially in the lead up to the financial crisis. He was a very strong advocate of deregulating Wall Street, among other things that I'm not going to go into detail. But it's really worrying that someone like him has so much influence in the economic agenda of the Democratic Party, because I feel it's a reason why the Democrats fail to sufficiently differentiate themselves from Republicans, which have more extreme economic views. But honestly speaking, in terms of the tacit support for the US's economic model is shared by both parties. And I think Larry Summers is strongly responsible for at least the Democratic side of this equation. So, in recent months, he has been very vocal in his opposition to the COVID stimulus plans, resulting in some heated exchanges with some of his rivals, notably Paul Krugman. And he has also now migrated into inflation fear-mongering, which is usually the territory of libertarians. So, we're going to look at one of his articles that was published on May 24th in the Washington Post and debunk the arguments that he gives on why inflation is a risk. So let's start reading. We're not going to read through the whole thing, just the more important bits. And we'll start here. Now, the primary risk to the US economy is overheating and inflation. Even 6 months ago, it was reasonable to regard slow growth, high unemployment, and deflationary pressures as a predominant risk to the economy. Today, while continuing relief efforts are essential, the focus of our macroeconomic policy needs to change. Inflationary pressures are mounting from the boost in demand created by the $2 trillion plus in savings that Americans have accumulated during the pandemic, from large-scale Federal Reserve debt purchases, along with Fed forecasts of essentially zero interest rates into 2024, from roughly $3 trillion in fiscal stimulus passed by Congress, and from soaring stock and real estate prices. This is not just conjecture. The Consumer Price Index rose at 7.5% annual rate in the first quarter, and inflation expectations jumped at the fastest rate since inflation index bonds were introduced a generation ago. Already, consumer prices have risen almost as much as the Fed predicted for the whole year. So, I'm going to start with this claim of the large-scale Federal Reserve debt purchases contributing to inflation, because this is basically the printing money argument that you hear all the time from libertarians and other free market fundamentalists, and that needs to be debunked off the bat. And so here's a chart of the Consumer Price Index, of which inflation is based on. That's the blue line. And here's the monetary base. That's basically all the money in circulation, which is what is usually referred to as printing money, even though only a small fraction of this is actually physical currency. And as you can see, there was a massive, massive jump in the monetary base after the 2008, after the global financial crisis. And this was largely as a result of the Fed undertaking actions such as purchasing assets, as well as other monetary policies like quantitative easing. And this is unprecedented in history. Like the amount of money that was printed, like the size of the Fed balance sheet, which is practically identical. If you plot a chart of the Fed's balance sheet, it's practically identical to the monetary base. And it went up even higher during the coronavirus pandemic. But did we see any notable change in the consumer price index? None. And I should add, these are both, I made this chart using the same scale. I've indexed the monetary base to 1984, just as the standard consumer price index. So this is the same scale. And you can see if the inflation mongers, if the libertarians who always make hissy fits over printing money, If there was anything remotely true about that, you would see some change in the blue line, some notable jump, and you don't see anything. So that's one argument debunked. Now, what he mentions about the consumer price index rising at 7.5 annual rate. So this is a bit sneaky. It's not untrue, but it's a bit sneaky what he's doing, because most people look at this number and think, oh, 7.5 inflation is massive. And well, that is partly true. So here is this is the month-on-month change in prices. So this is month-on-month inflation, which is actually what he's using. He's not using the headline number, which is actually 4.2. But that's the year-on-year. So the headline number for inflation is usually the year-on-year number, not the month-on-month number. But the month-on-month really tells you more about how prices are trending. And you can see here that there is a jump. And the figures for this first quarter, which he is annualizing, so that is this rate, if it continued for the rest of the year, would lead to inflation of 7.5. That's what he's referring to. And yeah, it is higher than recent months, but I honestly can't look at this chart and think that it's that anomalous. You know what I mean? Especially when we see like how massively inflation fell at the beginning of lockdowns, and just the general trend of how it behaves. I think there's often an obsession with monthly numbers, especially if you're talking with like business economists. And I can tell you, as someone who worked in that environment for a whole decade, more than a decade actually, there's often this obsession with with monthly indicators, and I think you need to move forward and look at trends. And I still don't see this as a trend. It could be that in the next couple of months, we'll see a continuation of this, and then we can say, okay, maybe he is right. Maybe inflation is rising. But as I'll explain later, I also don't think that necessarily is an indication of a structural trend. So let's keep reading. Fed and Biden administration officials are entirely correct in pointing out that some of that inflation, such as last month's run-up in used car prices, is transitory. But not everything we are seeing is likely to be temporary. A variety of factors suggest that inflation may yet accelerate, including further price pressures as demand growth outstrips supply growth, rising material costs and diminished inventories, higher home prices that have so far not been reflected at all in official price indexes, and the impact of inflation expectations on purchasing behavior. I wonder if Larry Summers has ever advocated for house prices to be included in inflation, which is actually, they're not included. This is might sound shocking to people. I wonder if he's ever advocated for that. I don't think so. Because that's a way to keep inflation looking lower than it actually is. But anyway, what he describes here is a common phenomenon after a global crisis. When there is a global crisis, especially one of the magnitude that we faced in 2020, there is massive disruption of supply chains. That's a fact. And this results in consumer demand and producer supply generally not being in equilibrium for a while. Why? Because consumer demand can recover relatively easily. After a crisis, once your kind of material conditions improve sufficiently, your consumer patterns will very much resemble what they were before the crisis. On the other hand, producers have a much tougher time of returning to normal because, for example, a factory of a business that goes out of business, that goes bankrupt during a crisis, you'll have an idle factory right there. And it might take a long time before that factory is somehow put back into action. So supply tends to struggle to recover after a crisis. And that is why you will have a situation where consumer demand and producer supply will basically not recover at the same rate. And you'll have supply chain problems. You'll have basically what he's describing here, which happened after 2008, 2009, and has been happening as well in recent months. If you look, for example, at the cost of container prices for shipping, they've gone off like insanely high as a result of these disruptions. So that's evidence of this occurring, but he's still in what he's trying to imply here is that this will lead to kind of more permanent, longer term impacts on inflation. And I still think this is mostly transitory. This will resolve itself as the global economy returns to something resembling normality in the second half of this year. So I don't think this is a huge threat. Now, here's where we see sort of the impact of Larry Summers, his economic ideology. It kind of emerges. Higher minimum wages, strengthened unions, increased employee benefits, and strengthened regulation are all desirable, but they too all push up business cost and prices. So you can tell by this statement that he's not a huge fan of increased minimum wages and stronger unions. He often gives like some lip service to these things, but I don't think he's really committed to them. And why? Because he always adds a caveat to them. There's always a but. There's always a disclaimer. And to be fair, most economic policies will have some negative repercussions as well. But in a country like the U.S., given like the precarity of labor, it's hard to argue that higher minimum wages and strengthened unions are not a net good in every sense of the word. So, he's fear-mongering over things that should be prioritized as part of U.S. economic policy. It is possible that the Fed could contain inflationary pressures by raising interest rates without damaging the economy. But in the current environment, where markets around the world have been primed to believe that rates will remain very low for the foreseeable future, that will be very difficult, especially given the Fed's new commitment to wait until sustained inflation is apparent before acting. The history here is not encouraging. Every time the Fed has hit the brakes hard enough to slow growth meaningfully, the economy has gone into recession. Now, almost every op-ed that you'll ever see from Larry Summers, he throws at least one jab at the Fed. And I think the reason for that is because he wanted to be the Fed chairman. In 2013, he wanted to be the successor of Ben Bernanke. And there was a lot of pressure from the left wing of the Democratic Party to not have him there, precisely because of his record of on deregulation previous to his basic pro-market attitudes. So this was from 2013. He withdrew his consideration due to the pressure, and he had too much baggage. He was dogged by controversies, including his support for deregulation in the 1990s when he ran the Treasury Department in the Clinton administration, blamed by some for the financial crisis of 2007-2008. As well as for comments he made about women's aptitude while president of Harvard. These comments were actually really disgusting. I'm not going to comment on them. I just want to focus on his economic policies here. But he's not the greatest human being. I'm just going to leave it at that. And that's also why I'm not a huge fan of him in any way. So I think these comments sort of, like I said, he recurrently blames the Fed for causing recessions. And I think there's a degree of resentment. I think he's a bit jelly. So now here's the thing. He's basically describing what the Fed could do to prevent these inflationary pressures, which I think are quite reasonable. If the Fed realizes that there are, sustained inflation risks, they can raise rates. They can tighten monetary policy. But he said his excuse on why he thinks they won't do it is a bit lame. It's like, in the current environment where markets around the world have been primed to believe that the rates will remain low for the foreseeable future, do you actually think the Fed is going to care about global markets when their mandate involves maintaining price stability, and also when obviously businesses are interested in there being low inflation? No business is not going to support a move by the Fed to prevent inflation from rising. That's a fact. So it's not like the Fed is going to go against the current of business sentiment. It's actually going to do it because it benefits business. So I just don't know why he's making this argument. How much does it matter whether inflation accelerates? In general, increases in inflation disproportionately hurt the poor. Oh, he cares about the poor. and are associated with reductions in trust in government. Progressives might consider, he's clearly directing this comment at like progressives, might consider the role that inflation played in electing Richard Nixon in 1968 and Ronald Reagan in 1980. I can guarantee you that both of these people contributed to further mistrust in government. Why? Because Richard Nixon was a dirtbag. He was a sleazeball. And Ronald Reagan, basically, his entire political career revolved around blaming government for everything wrong in society. So you can still have people voted in due to a lack of trust in government and then contributing to further lack of trust in government. And I don't think this is an argument that most progressives are going to like really embrace, to be honest. Now he complains about the stimulus plan being too big. Here's his solutions. So first, starting at the Fed, policymakers need to help contain inflation expectations and reduce the risk of a major contractionary shock by implicitly recognizing that overheating and not excessive slack is a predominant near-term risk for the economy. Tightening is likely to be necessary, and it is critical to set the stage for that delicate process. Meanwhile, the administration needs to continue to respect the independence of the Fed as it changes course. This is a hilarious statement because he's almost painting the U.S. as like a crackpot third world country where the central bank is not independent. I mean, this is a very strange statement. And again, it's one of the many jabs he throws at the Fed in his op-eds. He's jelly. He's jelly. But I need to discuss this issue of overheating because one thing is accepting the possibility that the U.S. economy will overheat, and the other is accepting the what follows, which is that this will necessarily lead to inflation. So to assess the risk of overheating, I'm going to show a chart of potential GDP. That's the blue line. So potential GDP is the basically the rate of growth that an economy can sustain without generating inflation, right? So it's like the maximum level that you can run without overheating. And the red is what like actual GDP. This is the actual performance of GDP. And you can see, for example, these recessions, this was the dot-com recession, and this was the global financial crisis, were preceded by moments in which the red line was higher than the blue line for a sustained period, like around 2 years or so. And this is basically the risk that he's describing. Basically, you don't want the red line to be above the blue line for a sustained period because it raises the risk of inflation. Or so they say. Now, look how long it took, by the way. This is, if you haven't seen this chart or any variant of this chart, this is how long it really took the economy to recover to its to its potential level of growth. So it took until pretty much the first quarter of 2018, almost a decade. That's how bad the 2008 recession was. And you can clearly see the difference. As bad as this crisis was, so the coronavirus crisis was much steeper. We saw a collapse in the early part of the pandemic that was much more violent than what we had back in 2008 when it felt like the world economy was basically collapsing around us. So this was much worse in terms of the immediate impact. But then the recovery has been much stronger, like very, very strong. And you can see here that the slope is slightly easing. It's not recovering at the same pace as immediately after lockdowns. But there's reason to believe that it will accelerate. For example, this goes up to the first quarter, and the second quarter is probably going to be quite good because the rate of vaccinations is much lower. There's a lot of states that are practically COVID-free, so people are going to be out. They're going to be consuming. They're going to be behaving much more like pre-pandemic conditions, and that's going to give a boost to the economy. So I do agree that the risk of the red line getting to the blue line in a much shorter period within the next 2 quarters, definitely by the end of the year, I think, is high. And then if we still have some impetus from the stimulus package, then that might cause it to go above the blue line and thus risk the overheating and the inflation that he claims. Now, here's the thing. There's 2 reasons why I think while the risk of overheating is plausible, I'm not sure if it will necessarily translate into inflation. The first is going back to this chart on inflation. If we look at how inflation behaved in the years before the two recessions, it wasn't that high, especially before the coronavirus pandemic. So this was the period in 2008 and 2009. And if you read like a lot of the economic news back in this period, there was a lot of fear mongering as well that the US economy was overheating, that eventually it was on course for a correction. That's usually the economic term for a slowdown or possibly a mild recession. And it eventually happened, obviously, because of COVID. This was an external correction, a very sharp correction. But it was not caused by the overheating itself. And there was no manifestation of inflation at all during this period. Now, prices were higher, admittedly, before the global financial crisis, but this was also partly because of oil prices. Oil prices had skyrocketed. In general, commodity prices were quite high. This was the tail end of the commodity supercycle, and that was one of the driving forces of inflation, which reached in July, mid-2008, which was when when oil prices were peaking. It reached 5.5%. That's really high by U.S. standards. The U.S. is accustomed to inflation averaging around 2%. So that's really the reason. And the other reason I think that he mentions is that comment that he made about the $2 trillion in savings, which is true. I'm going to show you a chart of personal savings. So the U.S. is known for being one of the countries in the West that saves the least. And if you look at savings rates before the global financial crisis, they were really low. They were like 3%. So we were having a boom that was largely driven by debt, not by anything else. And then this changed after the crisis. People wanted to basically reconstruct their balance sheets. If you look at a chart of household debt, you can see how it was rising and rising and rising. Then the crisis hit. And part of the reason why the economy took so long to recover is because there wasn't enough consumption. A lot of the saving, there was an increase in savings, and these savings were being used to pay off household debt, which went down and down, and then went up dramatically because you had that huge spike in unemployment in the early part of the pandemic. It's still much lower, by the way, than these peaks, so I don't think it's going to be a major issue. But here you have the massive jump in the savings rate. This is huge. So at the height of the first lockdown, you had practically a third of income was being saved. That's unprecedented. Again, this was like 3% back in the mid-2000s. So add up all the savings, adds up to $2 trillion, which is a huge amount. You would think, oh my God, if households right now have $2 trillion in savings and they're going to return to normality soon, what are they going to do with all those savings? They're just going to spend it. And all that spending is just going to generate more inflation. But that's not necessarily what might happen. So here's an article from the Federal Reserve Bank of Kansas City, which quotes a recent study that was made by one of their economists on why are Americans saving so much of their income. And this guy basically, the question is, what are they going to do? That's what we're interested in. What are they going to do with those savings? And he said, the $2 trillion question is, what are Americans going to do with their increased savings when the economy regains a more normal footing? He adds that Americans who save based on precautionary motives may be hesitant to tap savings in the future for consumer spending, choosing instead to continue to save for a rainy day. Conversely, those fortunate enough to continue working during the pandemic may essentially have been forced to save more since many parts of the economy remain closed. Some of this forced savings, he added, could be earmarked for future vacations, for example. Smith cautioned that estimates of which motive is driving consumers to save is imperfect. His analysis suggests that historical patterns of government transfer, savings, and consumption indicate much of the recent increase in savings is due to precautionary motives. Quote, therefore, this analysis cautions against the thought that all of these savings will be drawn down once the pandemic ends, he said. The lasting effects of this pandemic on consumer behavior remain largely unknown at this point. So, It is true, there is 2 trillion in savings right there. It is not true that all of this will necessarily be spent, and hence we are not sure whether this will trigger more pressure on consumer prices. So in that point, Summers is also wrong. Now, here's the part of the article that I really, really found disgusting. Second, policies towards workers should be aimed at the labor shortage that is our current reality. So this labor shortage idea has exploded in the last couple of weeks after the last unemployment numbers came out, and they were not that good, or rather employment numbers, the hiring, were not that good. And so the argument, the talking point now being circulated among the right is that people are being given very generous unemployment benefits as a result of the recent stimulus bill, and they're choosing not to work. They're lazy. They'd rather just not work. And it's really sad that Larry Summers is basically repeating that same argument without any questioning whatsoever. Unemployment benefits enabling workers to earn more by not working than working should surely be allowed to run out in September. In some parts of the country, they should end sooner. Here's an article from Fox Business, and this could be written by Larry Summers. Republican senators blast federal unemployment perks amid ongoing labor shortage. Senator Ernst, paying people not to work is not helpful. Part of the problem is that the government pays folks more to stay home than to go to work. Ernst will advocate for her bill, the Get Americans Back to Work Act, which aims to decrease the extra federal unemployment benefits to $150 per week by the end of May, before fully nixing them at the end of June this year. And she's clearly being joined by a lot of other Republican senators. And this is a talking point that right now is the main economic talking point among the right. And it's absolutely disgusting because it's not addressing the fact that maybe workers just aren't being paid enough to want to go back to work. And a lot of companies are addressing this by raising pay, which is what they should be doing. So it's really sad that he's basically copying ad verbatim this talking point. And pretty much goes to show what his real ideology is. And finally, it's essential to make long-term public investments to increase productivity and enable more people to work. It would be a grave error to cut back excessively on public investment ambitions out of inflation concerns. This is not because of the immediate jobs they create, but because of the long-term increases they generate in productive potential, sustainability, and inclusivity. But where possible, infrastructure investment should be financed by reprogramming of rescue plan funds, such as those now being used by some states to finance tax cuts. Additionally, current spending financed by future taxes might further stimulate an already overheated economy. It's not overheated. I showed the charts. It's not overheated. The opposite, revenue increases ahead of spending, or at least parallel to spending, can ensure more sustainable growth. I actually agree. Aside from this point about the economy being overheated, I genuinely agree with this point. I think this is his sort of token progressive point of supporting public investments for long-term productivity, which again, this is a good thing. And certainly the use of these rescue plan funds to finance tax cuts is ridiculous. Like it should not be used for that purpose. So he does make a point there. And this point about the use of delaying the increase in taxes, yeah, I do agree that could be problematic, because if you know that taxes are going to increase in the future, you're probably going to splurge on consumption earlier. Whereas if you do the revenue increases, at least as he mentions, in parallel or ahead of spending, I think they should do their planned tax reform now. So there's no objection for me with this regard. But still, this is just a very problematic op-ed for the reasons that I explained, because it repeats a lot of tropes about public spending and inflation. And I think that is really the game. That is really what Larry Summers wants. He doesn't want the government to be an agent of, mostly socioeconomic change. More than, again, his sort of token support for infrastructure might make it seem that he's not adverse to increase public spending, but it's sort of what public spending is used for. And this is what basically libertarians and free marketeers always argue. And it's just wrong. Like, it's just patently wrong. I mean, I showed how all this, the printing money argument is just completely ridiculous. And I've shown here the evidence that we've had periods of overheating with no inflation, and we don't know exactly what those savings are going to be used for. So is there a risk of overheating? Yeah, I do think there is. I think you can't seriously look at this chart and see how real GDP is behaving and say that the risk of overheating does not exist in the next couple of quarters. But his argument rests on two main assumptions. One being that the economy will overheat, which I insist is plausible. And the other, that inflation will be, three assumptions. So one, that the economy will overheat. Two, that this will necessarily lead to inflation. And three, that the Fed is going to screw up its response, because that's kind of what he's arguing here. Not kind of, he's openly saying that the Fed is going to botch it, because they either don't do enough early on when there's initial evidence of inflation, or that they're going to react far too violently and lead to another recession. So I think that is mostly based on his resentment, which I mentioned. It's not based on... I think the Fed is likely to have learned some of the mistakes in the past, because I do think they have made mistakes. But all in all, this is just a standard Larry Summers piece. And I recommend you... he's had a few discussions with some other economists. He had a debate with Paul Krugman, which I strongly recommend. You can find it on YouTube. I'll link it in the description. Maybe I'll do a reaction video. It's a bit long, but maybe I'll do that. So just don't buy this. Don't buy these arguments, and especially like this, the printing money argument. It's ridiculous. Like even in Venezuela, the rise in the monetary base has actually been lower than inflation. I know this because I covered Venezuela in my previous job for various years. And if the rise in the monetary base is lower than your inflation, then clearly inflation obeys other factors, not just printing money. So just don't buy this. If there's one issue that libertarians and kind of the free marketeer crowd has always been wrong about, it's when they start saying this, that inflation is around the corner, that we need to be worried. And if you go back and you Google like libertarian inflation risk or libertarian hyperinflation, and you set your range from like 2009 to 2012 or 13, you'll find no shortage of articles from these people arguing something that never happened. So that is my take on this. I could be wrong, of course, but I think recent history supports what I'm saying. And yeah, just be very skeptical of people like Larry Summers, and be cynical about what his real intention is, which in the end is basically to reduce the role of government in economic policy. That is the game, and he may use other arguments, but they all lead to that single point, which is, I think, the hallmark of his economic ideology. So, having said that, thanks for watching this video. If you liked it, please like, please share, please subscribe. It's a new channel. I appreciate all new subscribers. And I'll definitely be doing more economics content, because there is an absence of good economic analysis on lefty YouTube. So I hope to fill that niche in some way. So thanks again. Have a good day.